Okay, so my name's Peter Hartley. I'm Professor of Economics here at Rice University, and I'm on the National Council for the US Association for Energy Economics. And we're really pleased to have the Houston chapter of the International Association for Energy Economics hold their meeting here today. And we at the university are using this event to launch a student chapter of the IAEE, US IAEE here at Rice University. So all the students who are here, all the undergraduates, graduates, and also MBA students who are interested in energy economics, we want you to join the club. We've got a set of bylaws and so on, and we can also going to register the club with the Student Association here at the university. And we hope that the local Rice chapter will be able to join with the Houston chapter of the USAEE over the coming year for some more events we might have here on campus, or get the students down to some other events. So we'll probably be more about that coming in due course. So again, I'd like to welcome you to the campus, and thank you very much for agreeing to hold your meeting here today. Thank you.
I'm Skip York, the chapter president for the Houston chapter of the USAEE, and I really want to extend our thanks, the chapter's appreciation to Peter and Ken Medlock, Amy Jaffe, the Baker Institute, and Rice University for collaborating with us on what is a historic occasion in two ways. One, this is the first time that a local chapter has joined with a student organization to present, to have a presentation, and two, this is the first time that a chapter presentation has been broadcast live over the internet. We have at least 3 other chapters around the country who have wired in and are watching us right now. And we're hoping that this experiment works out successfully, because we think it's a great way to take advantage of the technology. One procedural announcement for the local chapter members. Our next meeting will be May 21st. James Griffin, who's a professor of economics at Texas A&M University in the Bush School of Government and Policy, will be discussing his new book that will by that point be published on energy security. So it should be a really he allowed me to read some of the galley prints, and it's a very interesting book, so we're looking forward to that presentation. As you may have noticed if you've been watching the website, this presentation and the speaker is different than what we originally announced. Andrew Slaughter was originally scheduled from Shell to speak about Shell's scenario planning. Unfortunately, Andrew's mother passed away, and we send our condolences to him and his family. And Candida Scott from CIRA has been very gracious to step in on extremely short notice to help us make this meeting a success. Candida is the Senior Director for Cost and Technology at CIRA. She directs their cost evaluation activity that they do there, and today she's going to talk to us about trends, cost trends in the energy industry. So without further hesitation, here's Candida.
Well, as a stand-in, I hope I'm not going to be a disappointment to you this morning. As we mentioned, it was prepared at very short notice, but the good thing is we're continuing doing this work, so hopefully what we've got are some interesting information for you. I had been talking with people about coming to do a presentation, and of course the key to us is a lot of the analysis we do on a quarterly basis. So you might at this point think, great, Q1 has just closed, so I'll have lots of lovely numbers to tell you. Well, it takes a few weeks. It takes 3 or 4 weeks to pull all the numbers together. So what I'm trying to give you this morning is kind of a sense of what we've seen from the numbers that we've gathered together. But we haven't actually got the Q1 points to be able to present that information to you. So let's talk a little bit about what has been going on in the cost world. I really want to talk about construction cost trends and where we are at this point and what might be happening going forward. And when I talk about construction cost trends, I'm going to focus on the energy sector. So upstream, downstream, and touch a little bit on power, just to complete the picture here. When we spoke about this topic in 2008, it was really a time where everybody was looking at costs, seeing the increases, and the general feeling was, well, you know, how high are costs going to go, and how quickly will the escalation actually take place? And the trajectory was ever upwards, and it was merely a matter of, you know, how do I change the slope of that line to actually predict out what costs will be going forward. And of course, the world has really changed since a year ago. Oil prices crashed, our commodities have crashed, and that obviously has an impact on what's going on with construction costs. And I'll address some of those issues and try and address the things that are making cost changes and the things that perhaps are having a stabilizing influence. Because the crash of oil price and the crash of steel and copper was very dramatic. And one thing I think everybody knows right now is we haven't seen that amount of dramatic crash yet, and may not even going forward. So we'll address some of those issues and the factors that kind of bring stability and also make changes. When the oil price crashed and our financial crisis in September, the energy industry kind of went into an introspective mode. They started looking at all of the projects that they were about to invest in 2009 and created something of a hiatus. Project constructions were pushed back, they started to review their costs, and it really posed a question for many of the energy companies, is if I'm going to go ahead with my projects in 2009, when is the right timing? Everybody would like to build when the costs are their absolute lowest and come on stream when the oil price is actually the highest. And we're going to talk about oil, gas and power, but as an example, you know, that would be the ideal world, get the best returns for the lowest investment cost. And at the end of 2008, this hiatus was really people looking introspectively. The companies were trying to assess what projects have I got on my book, what should we go ahead with, and what should the timing be. And what we saw as we got into about January this year, January, early February, a lot of the energy companies on the upstream side saying basically, well, my 2009 budget holds, or it's going to be 10% less, or it's going to be 20% less. But nobody really significantly, on the larger size oil companies, cut their budgets dramatically. And so we have a 2009 where we're anticipating sort of expenditures equal of 2008. Now, of course, the anticipation is costs will come down, so we could potentially do more with that money. So we had a hiatus while everybody looked at their projects, and we've kind of entered what is almost a gambling time at the moment. It's placing your bets of how much are costs going to drop and how low may they actually go, and what time will that be? When will be the bottom? We'll probably never get it right, but you'd like to think that you hadn't still got lots of cost de-escalation to go before you actually started your new construction. And so at this point, the disclaimer, I'm going to show here, these are the energy indexes that we publish, focused around capital costs. We do operating costs on the upstream side as well. And we track and monitor the upstream business, the downstream refining and petrochem, and the curve here is actually a power cost index for North America. We also do Europe, but it starts to get the chart very busy. So what you can see here is four curves that follow something of a similar pattern from about 2004 to 2007, which is cost escalation. A lot of labour rate increases, commodity increases, equipment increases, rig rates, really responding to supply and demand. We saw a large increase in demand, a lot more projects coming along, and the industry was responding to that. And I'm going to talk about their responses a little bit more in the moment, which kind of mirrors how we can forecast what's going to happen as we go forward. But if we just look at the situation right now, you can see, and hopefully everybody can read the index. So we have on the top there, the power capital cost, and you can see that actually peaked in 2007. And there's just a caveat with that. When we look at our power curves, we're tracking coal, gas, wind, and nuclear. And what actually drove that downturn in 2007 was a reduction in nuclear costs. Now, as you can see, what actually drove it up to that real high, again, was nuclear reactors. And that was really limited manufacturing capability coming out of Japan for some of the key component parts on reactors. And as those supply and demand issues and additional capacity came along, that started to reduce the costs very slightly on the new nuclear reactors. But as you'll see here, in the rest of our area, so in upstream operating, upstream capital, downstream, we've only really seen a downturn started about Q3 2008. And so really the Q1 to Q3 last year was a pivotal point in costs actually stopping escalation and starting to come down. You'll notice, of course, that that slope is nowhere near what happened to the oil price and is nowhere near what happened to the steel price. The initial decline here for the three indexes actually is coming from the commodities crash. And interestingly, what happened in 2008 was steel costs escalated dramatically. And in fact, the specialist steels required for the energy industry increased even more than general steel. And when general steel crashed, there was still reasonable demand and backlogs for the specialist steels in the energy industry, that the crash in the basic steel that you see tracked for automotive, white goods, things like that, that crashed and crashed very quickly, probably back down to the cost floor right now. But it's taken time for the specialist steels to really pass through. And then the other thing is tubular goods. In the middle 6 months of 2008, we saw a huge increase in tubular goods, casing, tubing that required by the oil industry. And they actually, again, escalated up much higher in 2008. Now, if you look around and just drive anywhere around Houston, you can see piles and piles of casing and tubing, a real indication of perhaps what's happening at the end of Q1. But again, it took time for that change in cost to be passed through. Another impact, and again, the sort of Q3 to Q4 of 2008 impact was copper. And again, copper, a commodity that very much crashed. The effect within our industry is in things like cabling, where copper is used, transformers, things like that. And again, it takes a little bit of time for that to be passed through. In things like electrical cabling, it's a lot quicker than something like a major piece of equipment. So what also happened in 2008? Well, 2008 until September was a really good year for oilfield services companies, for equipment companies, and they built up substantial backlogs of equipment. So in 2008, many of the areas did not say, great, you know, here we go, things are going great, we'll add an additional factory here, we'll add space here, and we'll just produce more goods. They actually built up quite substantial backlogs on their order books, and they simply pushed out delivery time. And we've seen delivery times over the last couple of years increase from 1.5 to 2 times what they were before really the supply and demand started to get quite critical. So they basically have substantial backlogs that were built up in 2008. And of course, what's not happened is projects in the construction phase have not actually been cancelled, or the majority of them. So any project that's in construction is going to continue requiring labour, is going to continue requiring equipment and all of the oil field services. And so the backlogs will somewhat be sustained by projects already committed before we got to the financial crisis in 2008. And of course, there are things that companies can do that can actually sustain some of those backlogs, and we'll mention those a little bit more in the moment, just to assess how that can impact our short-term forecast. So moving on.
Can I ask a question? Is that international or US?
Well, that one, the only line on there that is North America only is power. Everything else is international and US combined. And so if you think right now about what is happening on the US side, and I'm going to talk a little bit more about that, but if you think about just rig rates, let's address that, because the rigs are the barometer of the upstream industry. So if you think about rig rates, what we've seen, and I haven't got a curve here, but what we've seen around the world is considerable escalation in day rate costs for rigs. Now, what's happened since about September time 2008 is that we've started to see a drop-off in US gas drilling. We've started to see a drop-off in Canada. We've started to see some flexibility in the jack-up rates in the Gulf of Mexico. So there are things happening around the rig issue that are beginning to bring the rig rates down. Now, having said that, when you look at all of the other semi-submersibles and rigs required for the deeper water areas, I'm going to talk a little bit more about this, about lessons learned from the 80s. There's been quite a lot of stability in rigs that really came from some of the lessons learned about the 80s and the type of contracts to put in place. So I'll kind of address a little bit more of that in a moment as we go through the presentation.
But you really speak to the sense I get is you really speak to the amount of momentum that had gotten built into the system that really has tended to keep this from just dropping off the cliff like some of the commodities prices have.
Absolutely, and the momentum is essentially the backlog orders. It's the projects still going through the construction phase, because they're, any project's going to take 3 or 4 years probably to go all the way through that phase. So that amount of investment is a sustaining factor. And I've got a slide at the end that looks at the balance between those things that can push costs up or keep them steady, and those things that will bring them down. And we can just jump ahead and talk about anything. I actually wanted to talk a little bit about GDP, because the energy industry is often in its own little cycles and its own little world, particularly on the upstream side. And so oil price tends to be more of a barometer for the upstream industry. But GDP growth is actually quite important. And if you look back over the last few years, when we've looked at world economic growth, it's tended to be on the positive side. And in fact, places like Japan were looking at 10, 11, 12% economic growth. They're actually still got an estimate projection for 2009 of it being positive. But the world, this actually comes from one of our sister companies. Sarah's owned by IHS, and Global Insights is one of their companies, and they do a lot of forecasting on foreign exchange and particularly on economic growth. And so I've worked with them here to say, what is the anticipation for economic growth in 2009? And you'll see this is a blip into the negative. And the reason I'm presenting this and talking about energy is this actually really represents what we should expect to see in 2009. Without a doubt, we're in a very, very large recession. And one of the key questions is, when will we come out of this recession? Because with slow economic or negative economic growth, your general industrial construction is going to be very much impacted by negative economic growth. And so just the general things that kind of overlap with the energy industry, your civils and construction material, some of your non-specialist workforces, things that again overlap, like just tarmac and stuff like that, rebar. This GDP growth will have an impact onto our overall costs. And a negative GDP growth also, there are other areas that make you think, and one of them is what happened in 2008 was all of a sudden overnight shipping costs drop dramatically. and there were kind of anecdotal stories of, you know, we'll work for fuel, and we'll ship your goods for free because it's the return leg home or whatever. And so that's really an indication of trade between countries and general industrial growth. And so a minus 2.2% for 2009 probably means that in 2009 our shipping costs are going to stay at very minimalistic rates. And that actually brings some sort of equality into global procurement. Because if your shipping costs are staying fairly low, it's a lower factor in looking at your equipment or services that you buy around the world that have to be transported. I'm not going to talk about foreign exchange, but that also is a key driver in maybe unstabilizing and level international playing field. Can't talk about upstream without talking about oil prices. And just showing here, I want to talk a little bit about what has happened, because demand has dropped off. And this is where the cycle for oil price and the recession have really come together at the same time. So what we've seen already is a drop-off in demand for oil. We've seen an OPEC response to try and cut back on capacity. 12 months ago, OPEC was trying to increase supply. We've seen oil prices be at $140+. And if you look on the curve here, the bars are actually world demand, and the blue line is spare capacity. And if you look when we were $140 per barrel in 2008, you can see our spare capacity had actually increased from 2004. And a lot of this is the oil price coming back to the fundamentals of supply and demand. When we got up to $140 a barrel, there was the whole element of speculation in there as well. But typically, within CERA, when we're looking at oil prices, we're trying to analyze it from a fundamental supply and demand perspective to be able to define what oil prices are going to be. The interesting thing here is look at the spare capacity in the 80s. And of course, the 80s is probably one of the last big crashes, the 80s and maybe the late 90s. But I want to just touch on the 80s because for us who've been in the oil industry since the early 80s, we keep harking back to, you know, times were bad in the 80s and everything happened overnight and the rigs were laid up and everyone went home and everyone got laid off. And we're not seeing that necessarily in the same quantities that perhaps we saw in the 80s. And so I'm just going to draw on a couple of comparisons against what did happen in the 80s. Because there are things that are similar and there are things that are different. And the first fundamental difference comes right back to our oil price. What we saw in the 80s, and just to explain the graph here, we've kind of done it in months so we can compare current against 80s. And so as you can see in the 80s, we started a decline in oil price because of overcapacity. But it took 5 years, and it was like really 85 before we saw that drop. And the pink line is kind of the drop that we saw last year. So really the comparable point is the pink line to what happened at month 60 here. Now, let's think about what's similar to the 80s and what's different from the 80s. If we look at the equipment vendors and everything right now as one particular segment of the industry, what we see with our equipment vendors is they have much more substantial backlogs of orders than they did in the 80s. In the 80s, it was a ramp up, it was a bubble. People added on additional capacity. They built new factories. New rigs were constructed, brought to the market. And so when the final kind of downturn in oil price came, there was a crash. And it was very much a bubble that happened in the 80s. What happened this time around on the equipment side was that the vendors kind of said, well, you know, we've been here before, it is a roller coaster. let's look at ways we can increase capacity without actually doing substantial capital investment. And so they didn't necessarily go out and build a huge amount of additional fabrication facilities. They increased shifts, they increased overtime. They tried to bring in the equipment orders quicker than they had been doing in previous years, but it wasn't with a substantial investment. Now, on the drill rig side, we did go into building. We built a lot of new deep water rigs, a lot of semi-submersibles coming to the market. And of course, now we've seen this sharp decline in oil prices. Exploration always takes out a certain percentage of the drilling activity. But as yet, we haven't seen a crash across the board with rigs. We mentioned earlier US gas drilling. Yes, rigs are being laid up, prices are coming down. Jackups for shallow water. Yes, again, we're starting to see utilization rates fall. We're starting to see some flexibility in the day rates. But on our deeper water vessels, right now, there's still a reasonable amount of stability in the pricing. And one has to question, well, why hasn't it done yet what happened in the 80s? And of course, a lot of that comes from the fact that we learned something from the 80s, or at least the drilling contractors did. They went out there, and when they were committing to building new rigs at high investment costs, they were essentially putting contracts in place that had very high cancellation clauses. So that if the downturn came, or when the downturn came, it wasn't going to be automatically, that's it, stack up all those rigs and we'll wait for the good times to come again. And so what we're seeing right now on the rig front is oil companies, rig operators really having their own conversations, oil companies looking at where best to utilize the rigs that they're contracted to. And in fact, I believe right now in Latin America, we might even, when we get our Q1 numbers in, see a very small increase in rig rates overall. So it's not quite the same as the 80s. Some lessons have been learned. Another interesting area, because it kind of affects the human resources very much, is the EPC contracting market. When you analyze some of the major construction companies in the 80s, you actually see a very interesting combination of items. When revenues peaked, what sort of backlogs they had, and how they actually managed the downturn. We actually saw a peak in revenues probably on this chart at about month 0, but we didn't see the major layoffs until much later. And again, this is some of the sort of stabilizing effects in the fact that there were projects already in construction. They were going to work their way through, and only as design crews kind of came off a project and there was no new project to move to, did you start to see layoffs. So in the first kind of 50 months, we saw some managed layoffs over the time, and then obviously the sharp layoffs that came in the 80s that lost a lot of the engineering resources, G&G resources out of our industry, never to return. Interestingly enough, those companies that did significant layoffs did not build up a similar number of people till 2004. It took them probably 18, 19 years to really staff up again to the levels that we have today. Today, in general, those companies, and some of it's through kind of mergers and acquisitions of smaller companies, but essentially the return of the numbers has taken a long time after the layoffs in the 80s. And so this time around, as we see we've got the steep drop in oil price here, and we look out to the market, is we are starting to see some layoffs happening. Much of this tends to be in the engineering contractors, the actual contract personnel rather than the staff personnel. In the 80s, there were significant cuts in wages at that period of time for those remaining. We're not yet seeing that, apart I have some limited examples where I've heard of that, but we're not seeing that across the board yet. And so that gives us kind of a picture of perhaps where we are in the cycle as things play out. Something else different from the 80s and is actually quite important are the players. In 1995, this gives you an indication of sort of acreage holding of NOCs. And why this is important is if we look at that today, you'll see there's a significant increase in NOC activity. And the NOCs play differently than the majors and the private oil companies. They're out there exploring and developing fields for different goals. They're even prepared to accept different returns. And some of the stability in the rig market right now is coming from the activity of the NOCs, maintaining stability in that. Okay, so if we want to look forward and try and anticipate what might happen, we need to look at oil demand. And so this graph here really represents the different types of projects and fuels that we'll see over the next few years. So in trying to anticipate, basically what we're showing here is our previous projections of how all of these areas are going to grow as we went forward. So the bottom one in yellow is in production fields. The stripy red is under development. And the area of real interest is the dark blue triangle, which is under appraisal. If they're under development, they've already been committed to, and likely these projects will go ahead. So under appraisal, yet to find, which means we need to invest in exploration, and of course the biofuels and GTL are just a very slim sliver on the top. But our focus on the construction side is under appraisal. And there is a potential right now that we may look at about 7.6 thousand barrels a day of capacity growth, because we're looking at capacity here that's in risk if we don't go ahead with construction activity. And that, of course, is key to delivering oil going forward in the future. All of these projects, very few of them can actually be drilled and produced overnight. All of them are going to take a considerable period of time to actually deliver the capacity required. And so this starts to get an appreciation of we need to estimate how long this downturn is going to be. We've seen the demand for oil drop because of the recession, but is this a sustained long-term downturn? In which case then the 7.6 thousand barrels is not that important. But if this is a 1 or 2 year downturn and then the world picks up again, then if we cut back on the amount of construction investment we do in 2009 and 10, the implication is going to be much later on in the development process here. And so I mentioned before that I had some factors to consider of what can bring costs down and what might push them up or keep them stable. So what's driving costs to stay at the current level and what's bringing them down? So some of the key factors we mentioned a bit earlier, salaries. You can reduce your burden costs. You can cut back on overtime. You can cut back on benefits. You can cut back on all of the kind of plans and retainment schemes that were put in place. And that will give you some overall savings, and particularly will give some flexibility to those companies who are charging out on a sort of day rate basis, so your engineering contractors. But as I mentioned earlier, it's hard to actually, with the staff that you have, cut back on salaries. That doesn't mean it won't happen if this downturn is sustained for a long period of time. The other thing, but I fundamentally think at the best you could do is probably cut people's salaries 10% and retain that staff. So it's not a huge pull down. It's not going to give you the huge drops that commodities and oil prices have fallen in the last few months. We mentioned earlier the backlog orders, and right now they are really sustaining the equipment vendors and not putting undue pressure to really drop their prices. And one of the other things I want to talk about as we're talking about the equipment vendors is really, why can they not drop their prices? I think there's a lot of questions out there right now in the industry that, you know, costs need to come down and they need to come down now, and we want to get back to 2004 levels or whatever. The equipment vendors have very complex supply chains, many component parts coming from many sub-suppliers, and it simply takes time. Steel costs drop, yes, but will the equipment vendor see that the next day? No, unless he's buying actual raw steel and it's the particular grade that he needs. He needs to go to his forging or his casting vendor, and so it probably... The turbine manufacturers were telling me it takes about 9 months for all of these costs to be passed through. So 2 things helping equipment prices stay firm in the very, very short term, the next sort of 2 to 3 months. And that's because they still have backlogged orders and their supply chain is not yet passing through all the costs. Later in the year, we might see cost movements happening there, particularly if the amount of new construction doesn't pick up again. The other thing that equipment vendors can do, of course, as they look at the marketplace is, we mentioned earlier on, in places like yards, you can just cut back on overtime. And so again, that's a way that if you're sitting with backlogs and you're starting to see those backlogs decline, you could look at ways and means of sort of cutting back in your manufacturing capacity. And we've seen that terrifically in the steel industry as they tried to react to the huge crash in commodities. Seen a lot of production shut in the steel industry, and that's brought some stability to steel prices in the last few months. And so positive action there on something that's much more of a commodity and much easier to do is simply shut in plants. It was actually interesting because last year when the Chinese Olympics were on, we were kind of monitoring particularly the steel manufacturers around the Olympics and pollution, and they were going to be shut in, which they did for the Olympics, but the kind of crisis hit at the same time, and many of those didn't actually reopen after the Olympics, even though pollution was then going to be acceptable again. So, basically, cutting back on your production is a way that you can help balance prices. Now, as yet, we haven't really seen the equipment vendors doing it because they're committed to delivery times. Their backlogs do actually have delivery times. But if you look at things like big earth-moving equipment, for instance, there is several people who manufacture that type of equipment in the UK. Well, they moved to 4-day working weeks. And that was really a cost control measure. They could retain their people. They would pay them 20% less. They would basically just take longer to build the equipment, but they no longer had the backlog orders that they'd had in 2008 because that equipment gets built and delivered. Something similar with things like big cranes and everything like that as well. So actions that can be taken, and we've yet to see all of those actions coming into play. I mean, they could, if they chose, just shut in some of the manufacturing facilities and lay off staff and go back to the purchasers and say, well, if you want it, it's going to be another 6 months. Other things, we talked about tubulars and the stockpile of tubulars around. There are other things where it is really very specialist, where it's hard for those costs to come down simply because the amount of projects going through right now are going to maintain demand. So large diameter pipe, very specialist subsea equipment, although we have seen reasonable movements in Christmas trees and things like that, but not in the very high pressure range. And then the activity levels in the deep water and the really specialist deep water services are maintaining some stability now. So on the downside, what might push our costs down more? Well, of course, we've already talked about commodities. We're starting to see the effect of the basic steel price crash come through in all of the steel that we now require, the specialist steels for the energy industry. And we've mentioned it twice now, the amount of surplus tubular goods around there is, it was great actually for a while that ocean freight was so cheap, because the first thing that the suppliers did is look to ship them to really high areas that had shortages and high activity. And now, of course, basically they're going to look at having to sell them below the cost of manufacture. And then just the fact that the oil price has gone down, lower feedstocks translate into lower costs for things like paint, some of the chemicals that we need for production, and just fuel costs, bunker fuel for moving ships around. So that'll have an immediate and a noticeable effect. And that, of course, decreases our transportation costs and somewhat equalizes the global playing field for goods and services purchase. The general drop in industrial activity, this is a very interesting item, and the reason this is very interesting is we've cut back a lot already. So under things like civils and construction, basic labouring, I'm not talking about the skilled trade of electricians and welders and pipe fitters, because they're still right now in reasonable supply. Although again, we know of certain yards where they're using the skilled trades, and they've stopped overtime. And the project will be slightly longer, but it's brought an overall cost saving to them. But just general industrial activity has dropped quite considerably, and it impacts the cost of cement and tarmac and rebar and caterpillars and cranes and things like that. Now, the counter to that is, how will all of these stimulus packages play out? And there are a series of stimulus packages around the world, very large dollar figures on these. But you really have to delve into them to truly understand all of the implications. The US one has a strong component for renewables and may well help the wind industry, which has suffered quite a bit in the last few months, primarily because of the financing issues around wind, the additional wind turbine vendors that had come into the marketplace. But an emphasis on renewables may pick that up again. But otherwise, the sort of drop in industrial activity, it's hard to gauge at the moment how much the stimulus packages may help. In China, we actually see it might be quite significant. It's going into very tangible, just general infrastructure construction. Whereas in the US, it's probably about 10% of the annual general industrial activity. So it may have some sustaining price effect in some areas, but overall it's maybe not sufficient to really stop costs coming down. And so the other one, I said rigs were the barometer of the upstream industry, and of course they are. And as we see rig utilization falling, then we're going to see, of course, the effect onto rig rates, and not just in US gas, Canada, and jackups, but we're starting to see it in other areas of the world. There's a couple of semi-subs been stacked up in the North Sea, and we'll start to see that. And as that happens, of course, that is going to put a lot of downward pressure on rig rates. And just our general construction slowdown, of course, is going to impact across the energy industry. And then the other thing that we haven't seen in significant numbers yet is what is happening with staff. Will there be significant number of staff layoffs? It's generally said that a kind of a 5% cut in staff is usually kind of cleaning out the people who you didn't think were, contributing sufficiently to the organisation. When it gets larger than that, then it becomes quite crucial. And right now, we're starting to see people look at staff layoffs. And as we cut staff, obviously that's going to have an immediate effect on cost for the various companies who cut staff. Now, the issue may be is if you think this recession is only short term, and that was the first thing everybody said when we started talking to them, I don't want to cut staff, I don't want to do that this time around, because when the recovery comes, we won't have the people to be able to deal with the recovery. But it may become inevitable that staff cuts are seen. And so we've got this balance of things that might sustain costs at the current level. And if you think about oil prices right now, we probably are at an equivalent of about 2005 costs. And to get back to 2005 costs, we probably need to cut costs by about 30%. And we can see that here on the next graph. The key is, in our long-term thinking, is how are we coming down? Are we going to come down relatively quickly, or are we going to see some slow decline in costs? And really, this is the question that we're posed with as we discuss with all of the people that we work with, is how can we anticipate what this downturn is going to be? Are we about to enter in 2009 a very sharp downturn in costs that then basically stabilizes because oil price perhaps has stabilized? Right now, the SERA projection for oil prices in 2009 is between the $30 and $40 per barrel range. And so that would project that if that stayed all the way through into 2010, and we have the negative GDP growth that we saw earlier on, that we might see the costs coming in a relatively steep manner. And of course, you can't guess anything from the curves that I presented here because I haven't taken them from any point. But we essentially work with the companies that we work with, trying to forecast out what are the scenarios and effects that will give us the different downturns going forward. And so right now, as we go forward through 2009, we're looking at a reduction of costs in our forecasts when we get through to about September. That's inevitable and can be seen from the things that are happening in the industry right now. Longer term, it really becomes a question of, do we see that the stimulus packages that are coming into effect, that oil price will actually give us a recovery in 2010? Or if it stays low, are we actually on a longer term trajectory down? Into that equation, of course, you have to think about the items that will stabilize those cost declines and the things that might actually pull them down. So I'm leaving you with food for thought, really, because it's really the gambling stage of this analysis at the moment. And I think as we look at the investors into the energy industry, they're really right now trying to place their bets on the timing and the level that costs will come down. And as they place their bets, we'll start to see how that implicates the overall construction activity levels for the next couple of years and longer. Thank you. I'm happy to take questions if anyone wants.
We have time for a few questions if there's anything from the audience.
If people would use the microphone, it may be more accessible
for the broadcast.
Thank you. You mentioned that the deep water rigs and activity has held up, and you haven't seen declines because contractors had locked in the rates and made contracts difficult to cancel. But do you see new fixtures for these kinds of things coming down significantly in the coming year and maybe 2010?
Yeah, I mean, ultimately rig rates are going to start moving, and of course we do have still in construction rigs that were contracted to before the downturn came, and they've yet to come to the market. It was in 2008 that rigs under construction, as they kind of came out of the shipyard, they basically were going straight to the location to drill. That's not the case now with many of the rigs that are actually under construction. And so as they come to the market, I mean, they're partly built, it's unlikely that they'll be cancelled. So as they come to the market, we're likely to see that kind of unbalanced supply and demand a little bit.
One thing I see is, and if I'm interpreting the up and down arrows correctly, I don't get the sense that we see the kind of, for lack of a better term, decimation that we saw in the mid-'80s. It doesn't seem like you're projecting that type of outcome. It's a question of, yes, there'll be a decline. Is it sharp, or is it, you know, somewhat more attenuated? But am I right in understanding that? Okay.
Yeah. We don't believe that you'll see the substantial drops that you saw in that period of time. I was a late speaker, so I put those curves on as an indication of that there's different shapes and ways that you may see. And you know, one may be that in a couple of years' time, at Sarah, we love to look at scenarios. So we look at everything under a series of scenarios. And last year we had all three of our scenarios in 1 year, so that was brilliant. But probably won't see it this year. But one of our scenarios is really a Southeast Asian focused scenario, and really the rise and dominance of Southeast Asia. And when you think about Southeast Asia right now, and you look at the countries, you look at India, look at China, they're still in positive GDP growth. And so, you know, maybe the green line, and please don't, the up and down doesn't represent anything, but maybe a rebound is possible 2010, 2011, and maybe it comes from that Southeast Asia actually gets their act together and gets themselves in place much quicker than the rest of the world. And so that's one possible scenario as you look forward to the future.
Your comment actually plays into my question. Are the national oil companies more flexible or tougher negotiators with the suppliers than the traditional oil companies?
You know, I haven't been on an NOC equipment purchasing team to wonder about that. They are different in the fact that an NOC typically, well, he hasn't got shareholders to report to in the first place. Their goals have been production really for the home country. They've moved internationally to kind of sustain those. They're also more open to using their own home country suppliers. So if you look at something like China, one of the things we've been discussing with a lot of our clients is acceptance of Chinese equipment. That the Chinese can manufacture it cheaper. When does acceptance of those goods come into the marketplace? If you can buy it cheaper, or it had been in 2008 because you could get it quicker. And getting it quicker might reduce the overall schedule of your project because it was a critical path item. But yeah, when it really is how they can leverage their home country skills. And over the last few years, they've been doing a lot with the international oil companies. I mean, I remember working with the Chinese in the early 80s in Bohai Bay. So they were then looking at building up their own individual skills for the future. And so that they are prepared to accept more perhaps than some of the international oil companies to utilize their own sources. And that enables them perhaps to do the developments at a cheaper cost.
I know you touched upon this during your presentation, but you did not comment a whole lot on the energy stimulus and how that is going to make a big difference. Is that going to make a big difference at all? I think you commented about in the U.S. Yes.
Not very much on the upstream side. We're were not necessarily the favorite type of fuel. When did gas stop being a fossil fuel? That's a question I've got for everybody. I think it will have an effect on the renewables side. I think it will give some sustenance to wind turbine prices. But I think a lot of what was put in place for the US stimulus package was really aimed at renewables rather than at the conventionals, at upstream. And I mean, if you look at the downstream side, new projects are kind of being pushed off right, left and centre, basically, for investment because the margins have disappeared. The question on the stimulus package really is how much of that is just going into general industrial construction, because that's where it'll have a sustaining element on maintaining costs. But I don't think conventional upstream oil and gas is getting much advantage from the stimulus package. But you're welcome to correct me, anyone here, if you think otherwise.
Do you have any figures for world oil production under NOC, or any sense of what that may have been? And I noticed also on your graph you don't have Statoil and a couple of the others.
We actually track and monitor everybody, and we track it and by field, and I'm afraid I'm not going to remember the split of OPEC and non-OPEC, and I can't remember the split of NOC to international player, but yet the answer is yes, we do, but I'm so sorry I haven't got those figures in my head. Okay.
All right. Any other questions? All right. Well, I want to thank Kenny for jumping in, especially at the last minute. And once again, thank the Rice University and the Baker Institute for hosting us, and all those people who are watching us on the internet for participating in this endeavor. So, our next local meeting is May 21st, and with that, I'll call the meeting to we're adjourned.